I'm Steve Forbes, and you're watching Traders Nation.
Welcome back. You are tuned in to Traders Nation. My pleasure to have with us here today Jason Carrier, managing partner at Scranton Financial Group. Jason, welcome to Traders Nation. How are you today?
I'm good, Kurt. Thank you for having me.
Good. Thanks for being with us. Certainly appreciate it. You know, big swings in the market. Some giving some people some motion sickness. Certainly scared as cats too. I tell you what. Where's this movement coming from, Jason?
Well, you know, certainly the volatility is back.
Yeah.
I certainly felt like there was, you know, the terminology we use is a melting up in the markets. You know, that's a circumstance where people jump into the markets simply for, you know, because they don't want to miss out on any profits.
Sure.
There's really no fundamentals behind it.
Yeah.
And so the proof behind that is, you know, when Trump was elected, markets took off, and as they should have, the market priced in his future tax package that was eventually going to get passed. But once it got passed, the markets continued to rise. And that's where I felt like, you know, we were kind of overvalued at that point. So, yeah, we saw some pullback certainly over the last week or two.
Yeah.
I certainly didn't want to see it like that.
Sure.
You know, seeing 1,000, 1,500 point drops in the Dow is a little unsettling.
Yeah.
But the market needed that. The market needed to get that melting up scenario out of its system, and we needed to get back to fundamentals, technical analysis, and just watching, you know, seeing how the market plays out without, you know, investors just jumping into it for the sake of doing so.
Sure. Some are out there really saying, you know, a market correction is healthy, and certainly it is, right? But, you know, they were screaming market correction for quite some time, and eventually they'll be right. But I think, you know, as we saw those rises in the market, and 40% since the election, I think it's okay. Certainly, like you said, people were jumping on the bandwagon, didn't want to miss out, and you never chase after a runaway train, but some did, and then panic certainly ensued. But I think as we start to level out here, we'll be okay going forward, right?
Well, I think there are two things that kind of play here. I mean, if you look at all the technical analysis that's going on, the market is overvalued.
Yeah.
If you look at PE ratios, now I'm here in the state of Connecticut. I live just and work just down the road from Yale University. There's a very famous Nobel Prize-winning economist named Robert Shiller. He has a very popular technical analysis tool that's kind of followed out there. So if you look at all the technical analysis tools, the market is overvalued. That's without question.
Sure.
But on the same side, if you look at the fundamentals of these companies, their earnings and their profits aren't bad.
Right.
So how I see the markets, or the economy playing out here over the next, not few weeks, but maybe few years, is I do see the markets leveling price-wise. And I see that because earnings need to catch up. These companies need to catch up to this 40% increase that we saw over the last year. And that takes time. That takes years in some cases for the earnings to catch up to market capitalization.
Yeah.
So really the best case scenario, in my opinion, from a price perspective of the markets, I see a leveling effect. Okay. Worst case scenario, because this earnings takes time to catch up to capitalization, we might see, you know, you have to avoid some landmines. And we maybe avoided one just a couple weeks ago with the inflation report. But that's the problem with time, with the markets having to take time for these earnings to catch up. We got to avoid mouse traps. We got to avoid these little landmines. And what's that? You know, is there something going to pop up that's going to spook the markets?
Sure. Because you never know when you're going to get broadside. So what's the best way to avoid some of those landmines? Because like you said, some of these PE ratios they're in the high 20s. Okay, and the earnings are certainly in some single digits. So there is a big trailing effect behind that PE ratio that some of these companies have. So what is the best way to avoid some of those landmines?
Well, because I do believe, and we do believe here, that the markets will flatten over the next year or two, possibly three. You know, we're focusing on dividends and interest. So we're going to be trying to grow capital appreciation, or we're going to see capital appreciation through our investors' portfolios using dividends. We're not focused on price. If we are focused on price, it's only to try and generate greater yield. So try to focus, you know, again, if you believe what we believe, then there is only one other place where you can potentially grow your portfolios or grow your wealth, and again, that's through a portfolio focusing on dividends.
Okay, so dividends, fundamental. So really, long-term investors really need to sit back and keep an eye on the market with an eye, but also look at some of these plays, like you said, like dividend plays. You got fundamentals of companies that pay a nice dividend and ride it out, right?
Correct, and even maybe get away the equity market a little bit. You know, we've gone a little bit into some preferreds, where price or capital appreciation isn't as important. Again, higher dividend paying investments, and even the common stock. We focus a little bit on BDCs. Old term is private equity. Now that is common stock. You are going to see price fluctuations there, similar to you would in a common stock. But again, more focus on the dividends and interest.
Well, let me ask you one last question on dividends, because I don't want to belabor it. Companies, as they continue to grow and continue to prosper, maybe we'll see some of these companies increase what they shell on dividends, right? So we could see, on the dividend side, see an increase on dividends and what historically over the last, let's say, 5-8 years they've been paying, right?
Absolutely, and if you look back at the changes to the tax code, you know what companies are even more flush with money and cash. You know, what are they doing? Well, they're giving some to employees in the form of bonuses. And I agree. Maybe they start to, instead of reinvesting the money back into the company, maybe they just sort of pass through that tax savings to their stockholders in the form of a higher dividend.
Yeah, wouldn't that be dandy? All right, bond prices dropped to an increase. Dropped with an increase of in the 10-year Treasury note. Okay, I'm kind of concerned. Will the demand for U.S. Treasuries remain high, or what's going to happen there in the bond prices?
I think so. I think we're going to see some resistance on the 10-year Treasury around 3%, and here's why. You know, right now the United States and the U.S. Treasury is still the safest financial instrument in the world, by a long shot. But we are also, right now, for the most part, we're the highest paying 10-year Treasury in the world. So I don't know if this is a terminology I can use, but I kind of see what's called an inverted risk curve. Essentially, take less risk with a U.S. government Treasury, but get more reward. For example, you have two countries with like Italy and Spain who just a few years ago financially weren't doing very well. There was actually, particularly with Spain, the talk of default. Yeah, Spanish 10-year Treasury right now is under 1.5%. It's almost a full, 150 basis points under ours. So think about that logic for a second. You're a country like China or India, and you have capital that you wanted to invest. You have a choice. Take more risk with the Spanish Treasury at 1.5%, or take less risk in the United States Treasury at close to 3%. So I think it's that dynamic right there that's going to kind of put a cap or a governor and a resistance level on our treasuries at around 3%. And as you just mentioned a moment ago, kind of keep the demand high.
You know, the Chinese, they may not like our politics, but they sure love that return, don't they? And it's,
absolutely.
And over the years, this is quite a while back, we always had all that talk about Chinese pulling out of the dollar, et cetera. But you can't beat that. Money talks. It really does. And the Chinese, even though they're communists, they love that capitalism, too. All right, Jason. All right. Just as Americans start to feel that sense of prosperity, are we facing headwinds? I mean, there's a talk of inflation going on out there. We're almost out of time. What's the tweet answer on that one, Jason?
Well, I didn't think inflation was that powerful of a force, but that really is what triggered the market decrease over the last couple of weeks.
It did.
I do think there are a lot of positive forces out there, but we just learned that inflation can almost kind of trump, for lack of a better word, those other positive forces.
Where can we find you?
So,
where can we find you?
Yeah, Trump could be,
We'll be right back. Welcome back. You are tuned in to Traders Nation. My pleasure. Once again for having Jason Carrier on today. You can find him over at ScrantonFinancialGroup.com. ScrantonFinancialGroup.com. Head on over there today. Check him out. Awesome website, awesome services that Jason and his colleagues certainly perform for folks out there in the financial area. All right, we do appreciate his time. Came up against that hard break. I tell you, Don, we just can't help those hard breaks, can we? Sometimes.
That's right.